If you are over 60, if you have already retired, or if you are about to leave your job in the next few months, there is something the IRS expects you to understand immediately, and almost nobody explains it clearly when retirement begins. The day your paycheck stops, your tax life changes completely. When you were working, the system was doing most of the heavy lifting for you. Taxes were being withheld automatically. Payroll was sending money to the government behind the scenes. You could live your life, collect your paychecks, and trust that at least the basic tax machinery was moving in the background. But the moment you retire, that protection disappears. There is no employer standing between you and the IRS anymore. There is no automatic structure catching your mistakes before they happen. There is no retirement checklist sent to your mailbox explaining what comes next. And that is exactly why so many retirees get crushed in the first 2 years. Not because they were irresponsible, not because they were trying to do something shady, not because they ignored the law on purpose. They get hurt because the system changes overnight, and nobody sits them down and says, here are the rules now, here are the traps, here are the deadlines, here are the mistakes that can quietly drain thousands of dollars out of your retirement. That silence is expensive, because once retirement starts, every income source starts behaving differently. Social Security is treated differently. IRA withdrawals are treated differently. Medicare starts watching your income. The IRS starts expecting you to manage withholding yourself. Miss one piece of it, and the damage does not always show up immediately. Sometimes it shows up months later at tax time. Sometimes it shows up 2 years later in higher Medicare premiums. Sometimes it shows up in the form of a notice with a deadline you did not even know was running. And by then, the window to fix it is already closing. So in this video, I want to walk you through the 10 things the IRS expects you to do the moment you retire. These are the rules most retirees never hear clearly. These are the traps that punish innocent mistakes. And these are the moves that protect your money before the system gets a chance to take more of it than it should. This video is for educational purposes only and is not tax or financial advice. Always speak with a qualified tax professional before making decisions about your specific situation. My name is Ivan, and on this channel we break down the tax rules, the retirement traps, and the compliance threats that older Americans face when the system gets more aggressive and less forgiving. If you want serious, protective guidance built for retirees, stay with me until the end, because the last few mistakes in this list are the ones that can hit your bank account the hardest. The first thing the IRS expects you to understand is that retirement income does not behave like paycheck income. And that sounds simple, but this is where the first major damage begins. When you were employed, taxes were withheld from every paycheck automatically. It happened whether you thought about it or not. That withholding created discipline. It kept you current. It reduced the chance of a surprise bill. In retirement, that whole mechanism breaks apart. Your money may now come from Social Security, a pension, an IRA, investment income, rental property, or part-time work. And those streams do not always withhold enough tax, and sometimes they withhold nothing at all unless you actively set it up yourself. That is how retirees walk into underpayment penalties. They assume that because they will pay what they owe in April, everything will be fine. But the IRS does not think that way. The IRS expects taxes to be paid throughout the year, as income is received. So if your retirement income is coming in and too little tax is being sent along with it, the government can punish you even if you fully pay the balance when you file. That is what catches people off guard. They do not just owe tax. They owe tax plus a penalty, because nobody explained that retirement requires a new payment strategy. This is why one of the first things you need to do after retiring is review where your income is coming from and whether estimated tax payments or additional withholding need to be put in place. If that is not done early, the first April after retirement can feel like a financial ambush. The second thing retirees often miss is that Social Security is not automatically harmless from a tax standpoint. A lot of people enter retirement thinking that Social Security is either fully tax-free or close enough not to matter. That belief can get expensive very quickly, because depending on your total income, a large portion of your Social Security can become taxable. And if you are receiving monthly benefit checks with no withholding set up, the bill does not disappear. It just waits for you. That is why this becomes a cash flow problem as much as a tax problem. A surprise tax bill in retirement is not like a surprise bill in your working years. When you were earning a salary, there was more room to absorb a mistake. In retirement, a surprise bill can force you to take more money out of an IRA, liquidate investments, or pull from savings that were supposed to remain untouched. That extra withdrawal can then increase taxable income even more and start a second wave of damage. This is how the system punishes people. One thing leads to another. One missed setup becomes a chain reaction. That is why retirees who want protection do not wait until tax time to find out whether Social Security withholding should have been in place. They deal with it early, while the problem is still small and controllable. The third trap is even more dangerous because most retirees do not know the formula exists until it has already hurt them. The IRS uses something called provisional income to determine how much of your Social Security becomes taxable, and that formula is one of the most misunderstood parts of retirement taxation. This is what makes it so punishing. You may think you are simply taking an extra IRA withdrawal to cover a home repair, help a child, or take a long postponed trip. But that extra income does not just get taxed by itself. It can also drag more of your Social Security into the taxable column, so the real cost is often higher than it appears on the surface. That is why retirees in this zone can end up facing an effective tax hit that feels far heavier than expected. They thought they were making one simple decision. In reality, they were triggering two tax consequences at once. This is a perfect example of why retirement planning is different from ordinary tax filing. You are not just looking at isolated numbers anymore. You are looking at interaction. You are looking at pressure points. You are looking at how one move changes the treatment of another. And if you do not understand that, the IRS will still apply the formula whether you understood it or not. The fourth thing the system expects you to manage is your deductions, especially the senior-related ones that many retirees assume were already captured automatically. This is one of the quietest ways money gets lost in retirement. There is usually no dramatic warning, no angry notice, no threat in the mail, just a return that quietly overstates taxable income because something age-related was missed, overlooked, or never verified. That is why retirement tax preparation has to be treated like defense, not paperwork. Once you move into the senior years, different deduction opportunities may apply. Additional standard deduction amounts may matter. New rules may matter. Temporary changes in the law may matter. But many retirees trust the process too easily. They assume the software found it. They assume the preparer remembered it. They assume that because the return was filed, it must be correct. That is a dangerous assumption in a system this complex. If you are over 65, every return should be reviewed with one simple question in mind. Did I claim every protection the law allowed, or did I just accept whatever the system produced? Because those are not the same thing, and the difference between them can be thousands of dollars over the course of retirement. The fifth issue is required minimum distributions, and this is where the IRS becomes brutally clear. If you have a traditional IRA, a 401k, or another tax-deferred account, there comes a point when the government wants its turn. You are no longer allowed to let that money sit untouched forever. Required distributions must begin, and the rules around timing matter more than many retirees realize. This is where a lot of people make a mistake that looks harmless at first. They hear that the first required minimum distribution can sometimes be delayed into the following year, and they assume that delaying it is automatically smarter. But sometimes delay creates a much worse outcome. Because when you delay that first distribution, you can end up stacking two required withdrawals into the same calendar year. And that is where the damage spreads. Now more income lands on one return. That can push you into a higher bracket. It can make more of your Social Security taxable. It can affect Medicare premium calculations later. One delayed decision can create a tax pileup. This is why retirement tax strategy is always about the second consequence, not just the first. The question is never simply, what am I allowed to do? The real question is, what happens after I do it? Because the IRS may allow a delay, but that does not mean the delay protects you. In many cases, it does the opposite. And of course, if you miss the required amount or miscalculate it, the penalty is severe enough that this is not a rule you want to learn the hard way. The sixth thing many retirees miss is that charitable giving in retirement has to be handled more strategically than it was during their working years. A lot of generous people still use the wrong path without realizing how much extra damage it creates. They take money out of the IRA, let that withdrawal increase taxable income, and then donate from the checking account later. The charitable intent is good. The tax path is costly, because once adjusted gross income rises, it does not just affect one line on the return. It can affect Social Security taxation. It can affect Medicare surcharges. It can push other calculations in the wrong direction. So if you are already giving to charity and you are old enough to qualify for more tax-efficient IRA charitable strategies, the path the money takes matters enormously. This is one of the clearest examples of how retirees lose money, not because they made a bad decision, but because they made the right decision through the wrong channel. Same values, same generosity, very different tax outcome. And if you are trying to protect retirement income, that kind of difference matters. The seventh issue is one of the biggest planning opportunities in all of retirement, and it exists inside a narrow window that many people waste without even noticing it. I am talking about Roth conversions during the gap years. These are often the years after you retire, but before other retirement income fully stacks up against you. Maybe you have stopped working, but required minimum distributions have not started yet. Maybe Social Security has not begun, or maybe it has not yet combined with other income in the worst way. In many cases, these are lower income years. And lower income years can be extremely valuable, because later on, retirement gets crowded. Social Security is in the picture. RMDs are in the picture. Investment income may still be there. Medicare is watching income thresholds. Suddenly, the tax environment becomes much tighter, and the opportunity to move money from tax-deferred accounts into a Roth at manageable rates gets harder. That is why the gap years matter so much. This is not a move to do carelessly. It has to be calculated. It has to be sized correctly. But retirees who ignore this window often discover later that they gave up one of the best opportunities they had to reduce future tax pressure. They left themselves boxed in. And once the higher income years arrive, you cannot go back and reclaim the empty lower brackets you failed to use. That is why timing matters. Retirement is full of narrow windows, and this is one of the most important ones. The eighth trap is Medicare IRMAA, and this is one of the most frustrating rules in the retirement system because the punishment often arrives late. You make a financial move now, and the consequences show up later in the form of higher Medicare premiums. That delay is what makes it dangerous. A retiree does a Roth conversion, takes a large withdrawal, realizes a one-time capital gain, or sells an asset for a perfectly reasonable reason. Then, later on, Medicare looks back at prior income and decides premiums need to rise. Suddenly, the retiree is paying more every month, and many of them never connect that premium increase to the earlier tax decision that triggered it. But the system connects it. That is why retirement planning has to think 2 years ahead, not just one tax season ahead. Before any large income event happens, you need to ask what it does, not only to the current return, but to future Medicare costs. Otherwise, you may save or gain money in one area and lose part of it back through premium surcharges later. That is how retirement gets drained. Not always through one dramatic blow, often through a series of delayed consequences that were never explained clearly when the original decision was made. The ninth issue may sound administrative, but that is exactly why people underestimate it. If you move in retirement and the IRS does not have your correct address, you are exposed. Retirees move all the time. They downsize, they relocate, they move closer to children, they split time between states, they buy smaller homes, they rent for flexibility, and in the middle of all that transition, they assume mail forwarding will solve everything. That is not good enough when the IRS is involved, because every IRS notice has a deadline, and the government is not going to excuse a missed deadline just because the letter went to your old address and you never saw it in time. If a response was required, the clock was running whether you were aware of it or not. That is why every IRS letter has to be treated like an active threat until proven otherwise. Not because every letter is catastrophic, but because some of them become catastrophic when ignored. The danger is not always the first notice. The danger is what happens after no one responds. That is why retirees have to get serious about address updates and mail handling. In retirement, compliance is often about speed. A letter on the table is one thing. A missed deadline is something else entirely. And the 10th mistake is one of the most common, because it feels so harmless. Filing on autopilot. This is where retirees keep doing what they did a few years ago, because it worked once and became a habit. They take the same deduction approach. They assume the same filing pattern still makes sense. They stop rerunning the numbers because it feels easier to trust routine. But retirement punishes routine when the underlying math keeps changing. Property taxes change, mortgage interest changes, charitable giving changes, state tax exposure changes, age-based benefits change, federal law changes. The right answer one year may be the wrong answer the next year, and retirees who never recheck those numbers can quietly overpay for years. That is the kind of loss people rarely notice because it does not arrive as a bill. It arrives as money that should have stayed with you but did not. Money that was slowly drained by a filing habit that was never re-examined. And in retirement, that matters even more because every dollar has a longer job to do. This is no longer paycheck money that can be replaced with next month's salary. This is the money that has to protect your home, your health care, your daily life, and your independence. So let me bring all of this together. The moment you retire, the autopilot system ends. That is the real shift. You now have to think about whether enough tax is being paid throughout the year. You have to think about whether Social Security withholding belongs in place. You have to understand that extra income can make more of your Social Security taxable. You have to verify deductions instead of assuming they were captured. You have to know exactly when required distributions begin and what the timing does to your wider tax picture. You have to think carefully about charitable giving, Roth conversions, Medicare income thresholds, address changes, IRS notices, and deduction strategy. Those are the things the system expects you to know. And the most dangerous part is this. It expects you to know them whether anyone explained them to you or not. That is why so many retirees feel blindsided. They entered retirement believing they were just stepping into a quieter stage of life. What they actually stepped into was a more complex financial environment where timing matters more, mistakes cost more, and the government becomes less forgiving. So here's the final warning. If you are over 60, if you have already retired, or if retirement is approaching fast, do not assume you can handle this transition on autopilot. The IRS does not go easy on retirees who did not know the rules. Medicare does not soften the surcharge because the income spike was accidental. The system does not care that the mistake was innocent. It only cares that the number was wrong, the deadline was missed, or the income crossed the line. That is why you need to move before the next deadline, not after the next surprise. Review your withholding now. Review how Social Security fits into your taxable income now. Review your RMD timeline now. Review whether Roth conversions make sense while your window is still open. Review whether any planned withdrawals or gains could trigger Medicare costs later. Review your deductions. Review your mailing address. Review every assumption you carried into retirement from your working years. Because the biggest retirement tax mistakes usually do not start as disasters. They start as small assumptions, and then the system compounds them. If this video helped you, make sure you subscribe right now, because the next videos I am working on go even deeper into the rules that hit retirees hardest after age 63, after age 65, and once required minimum distributions begin. Those are the years when the system starts watching even more closely, and one wrong move can cost far more than most people expect. And if you know someone who just retired or is about to retire, send them this video today, because this is the checklist most people never get on their last day of work. And the sooner they see these traps, the better chance they have to protect what they spent a lifetime building. I will see you in the next one.